This morning was that classic everything is fine rally. Nvidia saved the entire world yesterday, futures exploded, tech ripped higher, and then the second the data hit today, boom, there goes reality. So let's talk about everything that happened today. So the data we got, it's not what people were expecting to see. After nearly 7 weeks of delay from the shutdown, we finally get the jobs report for September. We're heading into December now, so this is older data, but what did we get from it? Well, it looked pretty good. We got 119,000 jobs added in the month of September. That was more than double expectations because economists were looking for 50,000 jobs added. And we got more than double. So that was pretty awesome. But then you turn around and you look at the unemployment rate. That one ticked up to 4.4%. That's the highest in years, 4 years to be exact. So overall, what it revealed is this kind of mixed emotion. We got these job gains booming and then the unemployment rates ticking up. So this report, it's probably what the Fed least preferred. This strong headline number with a weak foundation that it's building off of. And job gains, they weren't very broad. They were basically healthcare, food services, social assistance. Meanwhile, transportation and warehousing and federal government jobs are where they were really on the struggle bus. But everything else, it was pretty flat, according to this report. And then summer got revised down again. July revised down. August revised down to a loss of 4,000 jobs. So combined revisions down were about 33,000 jobs. So the strong labor market from the summer period where everything was just looking really good, well, that turned out not to be real. It turned out a lot weaker than we thought. And then we also got the jobless claims data from the Department of Labor. And I'll put that on screen for us. And this added its own twist to everything. Initial claims came in at 220,000. That's low and stable. Insured unemployment rate came in at the highest since 2021. And that's the part nobody's talking about. Because insured unemployment rising means that people are losing their jobs and then they're not finding new ones quick enough. So then they have to turn around and collect unemployment benefits as this source of income just to kind of bridge the gap until they figure it out or they get content. But we also saw continued unemployment across all programs, ticking up to 1.78 million people. And then Verizon dropped this part right here. 13,000 layoffs, not hired back, not voluntary buyouts. These are actual cuts. So this is a sign, and that's not a tight labor market, everything's fine behavior, rather than that's we're preparing for slower growth in the future kind of feel to it. So the question, it really becomes, what would we imagine the Fed would think about this with hiring being weak, but layoffs are still slow, and with a report that completely solves nothing? We're pretty much in step one. And it supports both sides of the Fed's argument because you got one side that doesn't want to cut rates. See, look at that. We don't need to cut rates. We're just fine. Job growth is strong. Everything's just fine. And then the other side that doesn't want to cut rates, they're like, you're not looking at this number right here. Unemployment. It's a 4-year high. That's crazy. Labor supply is rising. Revisions are negative. We just need to cut rates as insurance. So both sides, they can argue they are right. And then the Fed minutes, they already showed strongly differing views inside of the FOMC. So ironically, today what we've seen is the CME Fed Watch tool ticked up a little bit to 1%. So we're still less than a half. Yesterday, this was 32%. Tomorrow, we might be 45%. But we're basically ping-ponging between these data pieces that we're getting because the data itself, it's distorted, it's delayed, incomplete. And in some cases, it's still missing. We might not even get it. But we don't know what the Fed will do necessarily. But we've seen how markets feel, and it was brutal out there. So after Nvidia yesterday, we talked about it. Markets were very happy about what they seen. They opened up like this. They gapped up. The NASDAQ was up more than 2%. Tech stocks were flying. AI stocks were really ripping higher. Sentiment was buzzing. And then about midday hit, and the entire market reversed course. And that ended up being the biggest intraday rug pull since back in April. And then by market close, we have this scenario where the NASDAQ opened up higher and then it fell, ending out down 2.16% on the day. The S&P 500, that one, 1.56 in the red. Then the Dow down 0.84%. Bitcoin, where's Bitcoin at? 6.17%. It's just all going down. It was a total unwind from where we were because we're like, oh yeah, Nvidia bailed out the markets. That wasn't enough. So why did we really get this move that we got today? Because it appeared everything was good, and then we get this labor market data, like more than double the jobs were created than we were expecting, right? Well, it's probably because Nvidia alone isn't enough to save this entire economy. The AI boost, yeah, it's real, but it's not so real that nobody knows how to price in risk right now, because there's still a lot of risk out there, and that's when these markets begin to fall apart. Ray Dalio jumped in today with a new warning, and it wasn't much, right? He's just said there's definitely a bubble forming. Everybody else has been saying that, but we're not at 1999 levels or 1929 levels. We're about 80% of the way there. So he's like saying like, hey, like we're getting a little high. We're not there yet, but it just kind of coincides with all of the other stuff we keep hearing. How like, hey, like expect a pullback soon. Like that's widely expected. Things have just been straight up over time. But Ray Dalio, back to him, he really just warned about the reason we might see this bubble territory is because people are scooping up leverage and they got weak hands. So weak hands using leverage, which before we talked about, but we'll talk about it again, margin debt levels according to FINRA being at $1.2 trillion. That's near all-time highs. Dalio's basically saying that there's this real risk, and it's not this AI build out rather than the amount of leveraged players who could be forced to sell upon, say, a margin call. These are players in the game leveraged up to their necks. So yeah, everything's going cool. Stocks are killing it. The data, in a way, like it's not terrible out there, and it kind of supports the Fed to just pause and sit tight, end out the year with only 2 cuts. But it's these leveraged players out here with these liquidity concerns, and all it's going to take is some more selling pressure, and then we could start seeing that show up in the real data. So with everything that's happened today, here's the bottom line. The labor market, it's not collapsing, but we do see further softening. The Fed, it's not united, but today's data, it doesn't really help that. And the market, it's not stable. It's reacting to every piece of incomplete data that we've gotten so far. So today exposed something important. Nvidia can move the market, of course, but it can't override the macro environment. Tomorrow, next week, especially December 10th, that's where we'll continue connecting the dots, because the data from today, it didn't really tell us anything. It only raised the stakes.